Today is February 5th, 2026, and this is the Commodities Institute podcast. I'm Emily Costa, and as always, I'm here to help you make sense of the forces moving the raw materials that power our world. We've got a lot to unpack today, and the common thread running through nearly every market is this. Governments are no longer standing on the sidelines. From oil and gas to cocoa and critical minerals, policy decisions and geopolitical strategy are shaping trade flows just as much as supply and demand fundamentals. Let's start with oil, where politics and barrels are once again tightly intertwined. The United States is reportedly pushing India to curb its purchases of Russian crude as part of a broader diplomatic and trade effort. Now, India has become one of the most important buyers of Russian seaborne oil since Western sanctions reshaped trade routes. At its peak last year, India was taking in roughly 2 million barrels per day of Russian crude. More recently, those flows have already started to slip, dropping sharply late last year. Why does that matter? Because if India, one of Russia's top customers, pulls back further, Moscow has limited alternatives. China is the obvious candidate, but it cannot simply absorb every displaced barrel without demanding deeper discounts. That would squeeze Russian oil revenues at a time when energy income is already under pressure. Lower prices, longer shipping distances, and a smaller pool of willing buyers all add friction and cost. But here's where it gets complicated. Oil markets are global and tightly balanced. If too many Russian barrels are forced offline or heavily discounted, we could see tighter supply elsewhere and firmer global prices. So even countries applying pressure have to think carefully about how far they can push without triggering higher fuel costs at home. It's a delicate balancing act between geopolitics and inflation. While governments are trying to reshape where oil flows, traders are busy managing price risk in a volatile environment. In the United States, activity in export-linked crude benchmarks has surged. Contracts tied to West Texas Intermediate crude delivered at Houston have seen record trading volumes. That tells us producers and traders alike are eager to lock in prices amid uncertainty. Tensions involving Iran, weather-related supply disruptions in North America, and shifting global flows have all added layers of unpredictability. When volatility rises, hedging becomes less of a luxury and more of a necessity. Now let's pivot to natural gas, specifically liquefied natural gas, where long-term security is back in fashion. Qatar has signed a massive long-duration supply deal with Japan's largest power generator. We're talking about millions of tons of liquefied natural gas per year for nearly 3 decades, starting later this decade. This is a striking shift for Japan. Over the past several years, Japanese buyers had been leaning towards shorter, more flexible contracts, especially from the United States, where cargoes can be redirected depending on market conditions. But recent geopolitical shocks and supply disruptions have reminded Tokyo that flexibility does not always equal security. Long-term, stable supply from a reliable producer like Qatar is now being viewed as an insurance policy against an increasingly uncertain world. For Qatar, these deals are crucial. The country is in the middle of a massive expansion that will lift its liquefied natural gas export capacity dramatically by the end of this decade. Locking in buyers today helps justify those investments and secures future revenue streams. So on one side, you have buyers seeking stability, and on the other, producers seeking guaranteed demand. That alignment is reshaping the structure of the global gas market. Staying in the energy space but moving into Europe, Serbia is also adjusting its energy relationships. Long heavily dependent on Russian gas, Belgrade is now actively seeking more supply through European channels and alternative pipeline routes. This is part of a broader trend across the continent where countries that once relied on a single dominant supplier are scrambling to diversify. New interconnectors, access to liquefied natural gas terminals, and regional purchasing schemes are all tools in that strategy. Diversification may come at a higher cost in some cases, but policymakers increasingly see it as the price of resilience. Let's turn now to metals, where another major policy story is unfolding. The United States is pushing for a coordinated trade framework among allied countries for critical minerals. These are the materials that go into electric vehicles, batteries, semiconductors, and advanced defense systems. The idea being discussed involves setting reference prices or even price floors among participating countries to prevent markets from being flooded with very cheap supply that undercuts new mining and processing projects elsewhere. The underlying concern is concentration. Processing of many key minerals is heavily dominated by a small number of players globally. That creates vulnerability. If supply is restricted or prices are manipulated, entire manufacturing sectors can feel the impact. By working with allies to support prices and investment, Washington and its partners are trying to build alternative supply chains. But there's a trade-off. Higher supported prices could mean higher costs for manufacturers, at least in the short term. So again, we see a familiar tension. Security and resilience versus affordability. Corporate strategy is also in focus in the mining world. Two giant diversified miners are still weighing a potential merger that could reshape the industry, especially in copper. Copper is central to the energy transition, from electric grids to electric vehicles. But investors are wary of overpaying at a time when commodity prices have been swinging sharply. Valuation, political risk, and the integration of very different corporate cultures are all big question marks. It's a reminder that even in a strong long-term demand story like copper, timing and price discipline matter. Now, let's bring agriculture into the picture. In India, trade negotiations with the United States are brushing up against a deeply sensitive issue: farmers' livelihoods. Agriculture employs a huge share of India's population, often on very small plots of land. That makes the sector politically powerful and socially delicate. While there may be room for lower barriers on certain high-value products like nuts, fruits, or beverages, core staples such as corn, soybeans, and dairy are much harder to open up, especially when questions around genetically modified crops come into play. Food security, rural incomes, and trade policy are tightly interwoven. Meanwhile, in West Africa, Ivory Coast's cocoa regulator is stepping in to buy large volumes of beans from farmers amid concerns about quality and storage conditions. Some cocoa has been stored in ways that risk deterioration, which could make it harder to sell on export markets without discounts. By intervening, the regulator is trying to stabilize farmer incomes and preserve value in the supply chain. But if quality concerns persist, international buyers may demand lower prices, which could ripple through global chocolate markets down the line. And briefly on grains, import tenders from countries like Algeria and Turkey for feed barley highlight how weather issues and local harvest shortfalls can quickly translate into global trade flows. When domestic production disappoints, governments move into the international market to secure supplies, supporting demand and sometimes prices in exporting regions. Across all these stories, oil, gas, metals, soft commodities, the pattern is clear. Markets are not just reacting to weather, geology, or seasonal demand. They are reacting to policy choices, strategic alliances, and geopolitical fault lines. For traders, producers, and consumers, understanding commodities today means understanding politics just as much as production. That's all for today's episode. If you found this episode valuable, be sure to subscribe, share, and leave a review.